Welcome to the Dividend Talk podcast, episode 215. Fire through high yield dividend stocks. Is it sustainable? Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom and I'm joined with my co-host European DGI. If you want to learn more about us, please visit europeandgi.com where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DGI. How are you, friend?
I'm good. Sunday evening, had a great weekend. Maybe for our listeners, we're recording later because we're both full with football in the weekends, which made it a bit hard for us to record on Friday. But next week will be the same, by the way. We'll also record again on Sunday evening. If all goes well, we have many mystery from Facebook on the show. I'm really looking forward to that because he did a nice update on Facebook, and we know him already a lot, right? He was also one time in one of the live shows present, and he really nicely wrote about, he kind of figured it out, what his optimal portfolio looks like. And I think this is very inspirational for many of us. So I've got so many questions to ask, but that's for next week. I'm also really looking forward to today's show because I think the topic is a question that I think we all think about sometimes. Yeah, just make a really high yield portfolio. But the question then is like, is this really sustainable, right? So really looking forward for that. But how are you doing, Derek?
Good. You talk about football. In your case, it's playing. In my case, it's following my children around and they play the football. But yeah, it's been quite a hectic weekend. So I'm glad we're doing this on Sunday. Actually, I was wrecked on Friday even. So I'm glad it's Sunday. But looking forward to this podcast. As you said, we spoke about the income factor before. If you remember that book, it comes up quite a bit, which talks about a higher yield kind of portfolio in terms of trying to chase fire quicker. So we might talk a little bit about that and what it means, and maybe one or two stocks that we have in our portfolio that might reflect something like that. So, looking forward to it. But before that, let's get into the news. And Nike reported their earnings. What did you make of them?
Well, it's very interesting because maybe, earnings season is slowly starting. We do know that Nike has a different fiscal year end. So it was the fiscal 2025 first quarter results, and their fiscal quarter ended on the 31st of August. We will now see a lot of stocks coming in that ended in, I think, September. So give it still 2-3 weeks and it will be full bang earnings season. Nike has been struggling, right? We wrote also about it a bit. We did dividend stock card for our premium subscribers about that as well. And one of the things I think, if you really think deeply about it, is like the former CEO doubled down on this direct-to-consumer business a lot, and therefore kind of forgot about the whole ecosystem, the wholesalers, where Nike is all the time on display. Yeah. So what happened, what the narrative is that their competitors got more shelf space and they benefited from that. And now it's a bit hard to get that competition back, right? So Nike kind of opened the doors unintentionally for its competition here. And this has impact, I guess. So generally the revenues are down by 10% compared to the last year. The direct revenues, so the direct to consumers, were 4.7 billion. This is about 40% of their business. down 13%, and the wholesale revenues, they were around 6.4 billion, down about 8%. Again, what they have been doing really well is increasing their gross margin. Yeah. But all in all, their earnings per share is now 70 cents, down 26%, which is quite a big of a reduction. So you can imagine the share price follows with that as well. And I think this shows you the struggle that Nike is going through. It's very clear in this earnings report. They have a new CEO on board. So yeah, we need to give him some time. I hope this is also something as a kitchen sink quarter. But he even says it himself, right? A comeback at this scale takes time, but they see already early wins. So look, for me, Nike, the swoosh is legendary. This company knows it has a problem. I mean, I'm not so concerned about that, and I happily initiated a position not too long ago, and maybe we'll get a second chance if it would dip significantly. I'm actually quite looking forward for that, because it's a company that was always, too far away from me, and yeah, now it's kind of in a zone that I feel like, yeah, come baby, come baby, come. So, but what do you think about Nike?
Yeah, it's struggling at the moment, and we spoke a little bit about the CEO Elliot Hill coming back into the company. Yeah, I just look at their little verbiage. We see early wins. I don't see any early wins here. This is kind of corporate speak to try and build some positivity around a company that's struggling. So, as you said, it's too early to tell how he'll turn this around. It will be, as he said, a hard task. Turning a big ship around is sometimes not easy. So yeah, we'll see. Look, I
this
don't.
is not a turnaround, right? For me, turnaround is Intel.
Yeah, it's
this
not.
This is kind of like, okay, some setbacks that just need fixing. Yeah, but I don't see it as like we need to go back to the fundamentals of our company, turn around the whole ship. I don't have that feeling. They need to do some recorrections. But for me, Intel, that was really a turnaround story, right? Nike is still very profitable and such. So,
of course, but fashion is very, how would you say, fickle at the best of times, and depending on your target audience, which is the younger generation, typically with Nike, that's involved in sports and athletics. Once they get a sense of another brand, it might be hard to turn them back.
So, yeah, but this has been already for ages. This is what I mean. We know that Nike is in the fashion industry. Yeah, the same as Adidas. So, I mean, you can never say 100%, but if they get, if they get the right mojo again, then it should be fine. I mean, kids here love it, but also the elderly, our generation. How many people walk with Nikes? Yeah,
I'm an Adidas man.
Okay, well, there are exceptions there. You're trying to support the German economy, I hear.
I stick to Europe.
They need it. They need it because
I stick to Europe. Yes.
Yeah.
Yeah. Look, I don't have the same conviction you have around Nike. It's a quite.
I don't have the highest conviction on this one, but why do I need to? It's not top 10 position for me. It's an initiating position. So, it's a brand I love to own.
Okay. Dividend hikes. Has there been many this week? I think we see 3 or 4 here.
Well, very interestingly, RPM International is a dividend king. 51 years of consecutive dividend growth, raised the dividend by 10.9% to 51 cents quarterly per share. Amazing. Yeah, we can clearly see that this is one of the biggest hikes. Not ever, but very long time.
Yeah.
Then when we look at defense stocks, and there's also a question for you later in the podcast about this, Lockheed Martin hiked the dividend by almost 5%, and 22 years of dividend growth. And then Colgate-Palmolive from the toothpaste, 61 years of dividend growth, 4.2% increase. I mean, I guess that every shareholder is happy with that. I mean, I know 4% is not the 7 or 8%, maybe what people are used to, but if you think about the environment we operate in, it's like a effing war everywhere, as it looks like. Inflation to the tits. So I think we're good here.
Yeah.
We take it, right? We
take it. Exactly. We'll take it. Do you know what? I might take that question now as well from Medrad. It's in relation to Lockheed. And I did a deep dive
into BAE systems on our premium newsletter. And when I was writing that, and Medrad is quite right, I was a lot more, I would just say, bullish, or leaning a lot more to Lockheed Martin. They own a lot more of the market. Their dividend history is stronger. We know the American defense budgets are bigger. There's a lot of money pushing into them. But at the moment, I've been watching and buying a little bit more of BAE systems. And the reason for that is purely valuation. I think they're both really good companies. They both serve similar markets, just in slightly different niches. Obviously, BAE is more European based, not so much US based. But I remember when we wrote that article, Lockheed, I think it was trading just around fair value, which I had at about 465. Yeah. At the moment, it's trading at $605. So for me, it's just overvalued. It's a great company. If both were at an even playing field in terms of valuation, I would buy more. I would buy Lockheed. But it just comes down to valuation at the moment.
Yeah, the American empire still has a lot of, war ahead of them, let's say.
Yes, they've got big budgets.
Big budgets, yeah. And we pay for that, yeah.
Of course.
And then the American empire. Good, yeah. So a few dividend hikes. I love this section always because it's so motivating to see. Unfortunately, nothing of this in my portfolio. Hopefully next time again. In October, I think AbbVie is expecting a dividend hike, and I'm so looking forward for that one. I bought it all like in the high 60s. I think it's now 170 or something like that, and my yield on cost is quite decent. So if they come again with a 10% hike, it will be like champagne time next weekend. I will pop open a bottle there.
You'll be like Conor McGregor. You'll be saying, "Get the red panties. We've made it."
Yeah, but we need that. Why not? Come on. These dividend hikes, it's like I get a salary hike maybe once a year. Yeah. Do I need to wait a whole year to celebrate an income increase? I can do it with these little beggars. Yeah. Like, come on, man. I've got some, it's like a top 10 position. Yeah. Why not? We need to celebrate those little milestones.
Of course you do. You're right. You're dead right.
Exactly. Let a kaboom, pop, whatever it takes.
Kaboom. So fire through high-yielding dividend stocks. Is it sustainable? Okay, I think before we get into that, what does high yield mean to you?
For me, high yield means above 7%. Typically rather touching the 10%. That means high yield for me. That will be twice the current yield of my portfolio. And if I would invest in that, if I would sell all my shares now and invest in stocks doing that, I could retire today. So the question is, why I'm not doing it? Yeah, we'll get back to that later. Yeah, here. But that's I think a thought that many people have, and that's why I really wanted to touch on this topic. We often talk about yield traps and everything, but come on, not every high yielder is a yield trap. Yeah,
true.
So how do you look at it then? Like, typically when you have a high yield, the theory says that you get either the yield or you get the capital growth. There's kind of a decision you need to make. It's either one, but both is like a unicorn. So, and actually, if you think about some studies that have been done and market data, it often shows really that the higher yielded stocks tend to have slower capital appreciation than lower yield stocks. So how do you look at that? Do you support that narrative?
Yeah, I think so. I think the companies that I've seen definitely have lower capital appreciation growth if they have high yields, and I'm talking around 8, 9, 10%. I don't think it's a popular opinion because lots of people talk about total return and you need to have total return, but you got to remember your goal as a dividend growth investor. It's usually for income.
Yeah. We're income investors.
Exactly, income investors. So why worry about the capital appreciation part? It's nice and it gives you a nice ego boost to say, like you spoke about AbbVie, I bought them in the high 60s, they're now 170s. It kind of validates your investment case. I was right to buy them and that, but does it matter? Does the share price actually matter in that if they're hiking the dividend?
No. I locked in a certain yield at the time, 5 or 6%, and it has been growing, and it will probably touch at a certain moment 10%.
Exactly. So for me, the capital appreciation is always nice to have, but it's something that I don't really look for. It doesn't come into my investment thesis.
That's a quite unpopular opinion because on social
100%.
media I always have the total return police chasing me, saying that I'm stupid, effectively.
And I understand why they think that or why they want to go that route. But you have to remember that your goals are different to their goals. And maybe they are capital appreciation and they're going to sell the company at 4% a year. We've all read that, and withdraw 4% a year. But that's not my goal. My goal is not to make money from it growing in share price, because if it was, I don't know if I'd be sticking with just dividend growth companies, because there's definitely other companies out there that share price will grow a lot better than dividend growth companies.
Maybe just for reference, I looked up Upfee. I've got a 9.1% yield on cost. So if they hike by 10%, I will cross the 10% yield on cost, and it would be my second one, because only Chesnara did that so far for me. So yeah, okay, good.
But that's more exciting for you, that yield on cost, than share price.
Yes, honestly, I need to see growing share price over time, because how to say it demonstrates that the underlying earnings are growing, and we want to invest in growing businesses, not dying businesses. So I need to see some capital appreciation. But if it's 1-2% per year and I get another 7 or 8% per year in dividend, it's still like 10% for me. So I would be good with that. Of course, the dividend withholding tax comes on top of that. So that's where we have a leakage in our investment portfolio. But then you come again to the topic of, okay, let's invest for capital appreciation for 15 years and then sell everything and push it into dividend growth stocks. Like, I could do that. Yeah, I would be really schizophrenic if I would do that, because you've been then all the 15 years, you've been fine-tuning, mastering the art of finding growth stocks, and then suddenly you are like an expert in dividend growth stocks. I mean, maybe some people can do that.
If you write it down in black and white, it sounds like that should be the plan to follow, because at the moment we're not using this income. So we're
why taking the dividends, right? If you can get theoretically a higher growth and capital appreciation.
Yeah, theoretically. But I think psychologically it's, and we've spoken about this before, we've had growth investors on, psychologically I don't think it's as easy to do that. And at what point do you switch over? Because you might be really successful as a growth investor. So why would you go, okay, I'm really successful, I'm generating, let's have an arbitrary number, 20% per year capital appreciation growth. I'm going to stop that and go into dividend growth investing. No, you're not. You're just not going to do that. So yeah, I think psychologically there's a barrier there. So I'm an income investor first and foremost. I plan on retiring on this income at some point. I'm trying to fine tune my strategy, so I don't really care about share price.
And that's so important what you're saying now, having this clarity of what your investment strategy is. That's the only thing that matters. The only thing you should benchmark yourself against is your strategy.
100%. And look, I've been told I've been stupid a lot of the times on social media, and I've been told my strategy is wrong, both in person and on social media. But at the end of the day, it's my money. I'm putting my money into what I think benefits me, and that's all that matters, I think.
Yeah, exactly. And you know, in 3 years or so, I should be financially independent. So yeah.
And you can get this little badge on Facebook that we have returned.
Oh, yes, exactly.
But then when we speak of high yielders, I mean, the first thing that people will say is it sustainable? Will they cut the dividend? I mean, surely there's some research out there that will support this.
Yeah, and it supports it mainly in economic downturns and recessions. So yes, when you have high yielding stocks in that category, they tend to cut the dividend more than the ones with a higher yield. This has to do a lot with the payout ratio. So if you have a payout ratio of 80 or 90% or 100%, it's not a lot of wiggle room left, right? The beauty is, let's say we saw a real crash like 4 years ago, and then 16 years ago, 15 years ago. Let's assume that this business during COVID was still thriving. So it was 16 years ago. You have 16 years ago benefited over very, very high yields, all the time. But then during a crisis, there's a higher likelihood that they will have to reduce because then quickly usually the covenants come into play, and it had it sometimes. In the past, I remember also ARCP, which became VRight. They rebranded, which then Realty Income bought. They had fraud as well, but it was kind of up in the air already that their high yield was just not sustainable. But as a dividend community back in 2014, 2015, we're all pouring money into this, yeah. So I do believe that, and research also confirms that these high yielders have higher risk of dividend cuts, and I think this is something important. So, if I would be fully in a high yield portfolio, I would really build a 30-40% cushion before I would say this is my fire date. I think I would really need to go for fat fire to anticipate during a crisis on a dividend cut, so that I could carry that dividend cut.
Yeah.
Those dividend cuts, and they will never cut to zero at all straight away, right? That usually doesn't happen, but half of it or something like that, and then some will stay, others will do half, some will even do a little bit more. So I think a 30-40% overall portfolio trim off may be likely.
Yeah, it's interesting what you said around the use are likely to cut it during economic downturns or times where financial crisis, COVID. So there's always probably a buffer where there's a time you can get out just before they cut that dividend.
Yeah, but then you need to know when that comes, and then usually with such stocks you may be usually already at a very low share price. Yeah. So usually the issue is with such stocks, if there comes a dividend cut, the price already anticipated on that went already down. The dividend yield went maybe up to 15 or 20%. We've seen that in the past. Think about Medical Properties Trust as an example, and that there you are. Yeah. So you have also lost your capital appreciation then. So you really would need to be able to anticipate a recession, and we know that economists. They predicted 12 of the last 2 recessions. So you'll be selling 12 times, maybe 8 times if you're easily influenced. That makes it hard, right?
Yeah.
That makes it really hard. So I would go for a buffer in such case. Really for a buffer, let's say take a portfolio yield of 8% on average, let's say, and make sure that's like a 30 to 40% buffer. So in the end, you would have a 5% real yield compared to other stocks I would do. And then also it means that in the good years, you have 30 to 40% money left that you can reinvest.
Yeah.
And that makes such a strategy, I think, then really interesting, that you have money left that you can reinvest.
Yeah. Like between 2008 and COVID, there was quite a stretch there. Like, so if you were investing in an 8% yield or plus, you would have major money back on your initial investment, plus 50% on top of that. So there is a bit of a buffer built into that. But the problem is you don't know how long of the good years we will get. Because if you start that strategy in 2019, in 2020, you get 1 year and you're losing all your money.
Yeah. And it's nice that you say that, because I have this with Omega Healthcare Investments. I earned probably around 60-70% back since I own it in dividends. It pays about 10% yield on cost for me almost. Yeah, it has a current yield of 6.8%. It's currently trading at about 40 euros. I bought it, I think, on average, maybe at $40, but I bought on average around $30. So only recently I got price appreciation on this one. Yeah, but I've got 60 to 70% already returned in dividends over all this time that I've been owning it, probably 7-8 years.
So does that make you think differently about them, knowing that you've got so much back that if...
Yeah, I feel comfortable with this one. It can drop really a lot. And of course, I want to, there's opportunity cost. I want to protect my return, right? I don't want it to drop 50-60%. But it demonstrates that this high yielder has been doing me very, very well. And if I look at my portfolio, only Shell paid me more dividends over the entire life cycle. It is Shell, then Omega Healthcare, then ExxonMobil, AbbVie, Ahold Delhaize, and BHP. Yeah, those have been my big dividend payers over the years.
Yeah. And BHP would fall in as one of those high yielders as well, I'd imagine.
Yeah. Although there it cuts the dividend all the time, but it has a certain dividend floor. So BHP and Rio Tinto are not dividend growers. They're cyclical. They follow the cycle. So sometimes there are fat years, and other times there are but more lean years. But still, on average, I would say get a really good dividend yield out on cost out of it. Yeah.
So when I hear you speak, then we can see the risks involved in owning such high yield companies. But do you have a certain allocation in your portfolio to such companies?
Not particularly, but a high yield allows me also sometimes to cheat on a low yield. So I've got an average of 2.75, and sometimes I think like, you know what, let's buy, let's say, Omega Healthcare at today it's, I think, it's a 6% yield, and let's combine it with a 1.5% yielder. I've done that sometimes in the past. So because my portfolio is not designed for high yield.
Yeah. But on that basis, right, you're averaging out. But if you were to sell Omega Healthcare, would you replace it then with something with a high yield? Would that matter to you because you've bought it?
Yeah, it would matter to me somehow. So yes, there is a natural allocation in my portfolio towards high yield. Maybe I should just retrospectively look at what it is and define that as my percentage of high yielders, let's say. Yeah. But yes, because the last thing I want is losing dividend income. But of course, if Omega Healthcare would cut the dividend and it would be half the share price, I cannot find. I wouldn't go for a 20% yielder. I would really just take it on the chin as a loss of income.
Yeah, it's quite interesting, isn't it? Because you're anchored to a certain amount of income, and we're growing our income year on year.
That's the biggest risk that I have. So if a 3% yielder cuts the dividend and would go half in price, I would be triggered to look at a 6% yielder to protect the dividend income.
Oh, interesting.
Yeah, that's how my psychology works. I noticed it for some times, and I'm doing that now with BASF. Yeah, so then I'm naturally looking at ASR as an example because it's kind of within a 1% range.
Yeah, but I feel like that's a natural way of thinking in our world, and it might be a flaw, but it
is a flaw. I think it is a flaw because it doesn't make us rational anymore, and we may therefore increase the risk in our portfolio.
Exactly. That's what I was getting to, because we talked about what you benchmark against, and I know you benchmark yourself off dividend income.
Yeah.
So if you had a 20% drop in dividend income, psychologically, I don't think that you'll be too happy about that. So you'll
exactly. I mean, I wouldn't jump off a bridge straight away, but
no. But you could make irrational decisions and chase more.
Yeah, true.
Companies.
True.
Interesting. So what kind of companies have you got in the portfolio then that are high yield?
Let me quickly look. So if we define it by 7%, right? Right now, then I have NN Group, let's say ASR as well, Legal and General. Cebus was a high yield, but it really raised in price, so not anymore. Still BASF pre-cut. I still have a few shares. Omega Healthcare, 6.8%, but we can also classify that one. Then I've got Chesnara, 9.27%, small position. I want to highlight that. And then we have UK Greencoat Wind. And I have, that's it. That's it in my portfolio.
No, nice. So what's your average portfolio yield again? 3-4%?
It is now 3.65%.
3.65. Yeah, you can imagine I have slightly more high yielders in my account. I think my average yield is 5.56%. British American Tobacco, Altria, NN Group, they are the high yielders. And then I have this like 10%, and maybe it's more 15% allocation to an income type factory setup where I did focus on closed-end funds in the United States. Then Interactive Brokers told me I can't invest in them anymore because they don't have key investor documents. But I have them now in these UK investment trusts, which are similar makeup, but they're managed by a fund manager. And some of them I have UKW, which you mentioned. But there's two other ones that I own. One which is Biopharma Credit, and then another one is this high yield. Is it New York CQS high yield income fund, and they're both yielding around 10% as well. So
if I heard you initially what you're talking about, then your portfolio is really like a big middle finger to the entire world that wants to make the world a better place, right?
Maybe. There's no ESG.
Come on, hey, be a man. You know, just be a man. You've got war. You've got heavy tobacco. Yeah, and then you've got probably something to insure yourself against all this stuff.
There's no sin stocks here. I got alcohol stocks. I got everything. I got absolutely everything.
I would divorce me if I would have your portfolio.
Let's just say the ESG rating on this would be quite low.
No. But British American Tobacco is probably like a 5-star ESG, right? They're building a better tomorrow.
Yeah.
So right. they have solar panels on the roof, so they probably score 5 stars.
BA say something similar. They're building a better tomorrow as well. So I mean, they're all building a better tomorrow for me. That's the point. That's the whole point.
Yeah. Oh boy.
Yeah, but it's funny you say that because it is these sin stocks that tend to have
high yields. Yeah. And there, I think the yields are typically even sustainable.
Yeah, you could argue.
I mean, they have a different risk profile.
Yeah,
but they just decide to pay out mostly all the earnings dividends. They are hardly reinvesting. Yeah,
exactly.
They are at that stage of the life cycle. In this case, tobacco stocks. So.
Yeah. I think the board knows that they're not going to make their shareholders rich with the share price, so they have to give it in dividends.
Yeah, exactly.
That's the business model.
Yeah, and then come on. So your yield is 5.something%.
5.56.
Have you never thought like with Dividend Bull or what is his name and the Income Factory? Let's throw it on 8-9% and let's YOLO quicker into retirement.
It does cross your mind at some point, but then you have to remember the sustainability about these. You mentioned the sin stocks.
Yeah.
So we look at British American Tobacco and all three that I have. They're a relatively high position in my portfolio, but that's because my portfolio, I would say, overall value is still quite immature in its overall scheme of things. I won't be adding more to these guys. So the risk is big on these. We know this. Decline in revenues, regulation, and on all these. And I really want to have a full portfolio where I'm not entirely comfortable if the dividend will be sustained in 10, 15 years. I don't think I could have that risk.
Yeah. So I'm just calculating, right? If I would sell Microsoft and Apple in my portfolio, I would increase I could increase the dividends almost 8 or 9-fold. This number would get me already to 75% part. I'm now it's 65. So I could increase in one single action 10% of my dividend income target rate.
You can't tell me you're not tempted.
Yeah, no, but this is the thing. It often skips my mind. Yeah, I know. So this is where the irrational investor is, right? I need them for my portfolio balance and everything. In general, to have a good combination between high yield and low yield and dividend growth, yeah. But yeah, it's very tempting, of course. I would need to pay some capital gain tax. But yeah, this is why for me this topic of the show is so interesting, because honestly, I do think that if you have a high yield dividend portfolio, that it can be sustainable. I think you need to anchor somewhere around 6 and 7%, take a buffer. Yeah, so it means you will have a few 10% yielders, 4-5% yielders. I think Alan from Sweden is doing this. I think it is possible. You take a buffer of 20 to 30%, and I think it's possible, and I think it will be sustainable. You just even get less capital appreciation than we have in our portfolios, and I think that's kind of okay. What for me would be the issue is the limitation I put on myself with the industries that I'm investing in.
Yeah.
because typically you end up in utilities, the energy companies at the bottom of the cycle or down in the cycle, insurance company in Europe at the moment. So that's what you end up with in your portfolio. And I think that would be my biggest fear, is the lack of diversification. Now I have some technology stocks in there. So I think it's kind of the difference between a sprint and a marathon. Yeah. But I do think it's sustainable, a higher yield portfolio. You just need to feel comfortable with the risk that you get yourself into. And I would really suggest to have an additional buffer to it.
Yeah, I think so, but I think the investment trusts in the UK, and I know
Mm-hmm.
that has many tax advantages for lots of investors. Some investors can't
Yeah.
invest there at all, and some can. But they're managed by portfolio managers that have a long history. You can
Mm-hmm.
check the history, well-defined dividend policies. Every single one of them.
Yeah.
They will tell you if they plan on growing it with inflation, not growing it, capital
Yeah.
appreciation. And I think there's an element of safety there as well. Not 100% safe, obviously there's risks, but I think it's easier to build a higher yielding portfolio using these vehicles than investing in single stocks, in my opinion. The risk in a single stock is always there, but at least if you have a portfolio and a fund managing lots of types of companies, I think that risk is eliminated. So no, I agree with you, and it's probably why my portfolio yield is so high, which is 5.5.
Good. Interesting topic. Maybe we should have someone on the show one time that has a high yield portfolio to speak from experience and how they deal with it. Would be good. So maybe if a listener has this, would like to talk about it, please write us an email at europeandgi@gmail.com, and we may get you on the show.
Perfect. Right, we got quite some questions to get through, so we'll try whiz through these ones.
Oh yeah, and I would like to start with the first one, because this is close to my heart. Board of Directors. And Ron Pizor wrote us a really nice email, because he's voting, right? And on when there's a proposal, let's say on the annual general meeting, and he was voting a share on Oracle, and he actually checked out the ages of the board members. And what is interesting here, Oracle is a tech company. Really got its rise in the early 2000s, and many of us know Oracle that work in the industry.
Yep.
And did you know that 10 out of 13 directors of Oracle are all past the normal age of retirement? I'm just naming up a few names here. How old do you think that Lawrence Ellison is?
Well, I know the answer. I'm looking at it.
89. Naomi Seligman, 86. Leon Panetta, 86. George Condas, 85. Michael Boskin, 78. Jeffrey Burke, 77. I mean, 79. Jeffrey Hellen, Charles Morman, 72. William Parrott, 79. Then we have Safra Katz, 62. And then Avo Ablo, I guess, is CEO, 52. What the hell is going on there? Is this like the Florida Retirement Club? Are they playing golf together?
This is jobs for the boys, just golden handshakes. That's all this is. I mean, for a tech company, I think this is ridiculous, because you can't tell me that someone, and no disrespect to Lawrence Ellison, I'm sure he's had a fine career in that world, but at 89 years of age, you can't tell me he's up to date on the current trends in the tech.
He was already retired at the .com bubble, probably.
Exactly. Like the world is fast paced. It's a lot different. Tech changes probably month to month, let alone year to year.
I mean, he's walking in with a rollator. I mean, this whole board is walking in with rollators. Is this a word in English? Such a thing that you use in front of you with wheels under it to walk. How do you call it?
It's like a crutch. I can't remember.
Like a crutch on wheels.
Yeah.
They're all coming in like that.
Yeah, I mean, can
you imagine that? And they have probably a young lady to support them to the chair and say, "Please, sir, sit." And then you hear all the bones cracking. I mean, this is the board there. It's insane. It's really insane. And that's exactly the question that Ron was asking. Like, they don't perform maybe the day-to-day job and the hiring, and they don't need to have all the details, the knowledge. But what do you have here? I think you just have a board here that loves in their after golf to still like do 4 or 5 meetings a year to kind of stay fit. That's probably it. But the CEO probably has a free ride here.
Yeah, I don't like it one bit. I mean, I think they're too old. I mean, it should be. Look, it's hard to put ages on it, but I think definitely in the tech industry, you need someone that has their finger on the pulse a little bit more in the industry.
I would love to see this board at Omega Healthcare, because Omega Healthcare is the last mile to someone's death. Yeah,
Yeah.
that's what they offer, and probably some of the board members are there now in one of their facilities. Yeah. Now, then you have direct customer feedback in your board. Yeah, they can speak from experience. But who's firing up an Oracle drive there?
Their
For the
assistant.
calculator?
Their assistant, yeah. Yeah, it's a crazy look. We could talk about this one all night. I think it's quite.
Oh, this one is for a beer. But Ron, thank you for bringing it to our attention. This is just insane. And well, you're an Oracle shareholder. You know our thoughts now. Good luck with owning them.
Vote them out.
Yeah, exactly. Vote them out.
Kevin has asked us a question about his recent performance review. And when he was asked where he saw himself in 5 years, his honest answer, and I love this, is probably retired or semi-retired. Okay. And feeling that this answer was met with kind of disconcern, he quickly laughed it off and made up some other goal to say, okay, that was a joke. So I suppose his question comes from that. I know some of my colleagues, my boss knows what I'm doing. Maybe not so many viewers know, but
how do they respond? How do they respond to it, knowing that you maybe they're just working for 5 to 10 years more?
Honestly, quite positively. I'm open with my boss on that, and
Yeah.
he's quite receptive of it. It hasn't got in the way of me progressing,
Yeah.
but I also think it depends on the person. It's case by case
Yeah.
basis. Like I know my boss now for 5 or 6 years. I know the personality. I know what he's like.
Yeah.
There's another boss in my department. I would say not directly reports to me, but if he was my boss,
Yeah.
I would not be saying, I wouldn't be as open. So I think it depends on
Yeah,
personality.
which is interesting, because I think they need to evaluate you like you're 55 years old. And what do people typically get when they are 50 plus? They have it hard on the job market, because the first questions they ask is like, why would they invest in you? Well, it's still 10, 15 years ahead of me. Yeah, okay, but I can get someone with 40 years that want to work at the company. But then the average tenure is never like that, of course. So there's an unconscious bias there.
But I also think there's an added pressure on my behalf, because if my performance drops, it would make my boss's job easier to say, he's not really committed here. He's already 1 foot out the door.
Yeah. Okay.
So,
someone is doing yoga and you're investing. Yeah. Okay. I get it.
No, but
Yeah, but you're right. Probably you're right, and that's one of the reasons, because that was the question about, is that I don't speak openly about it. My boss personally knows. He's very supportive. Also, because I guess I don't even have my mind up on what I want to do when I reach the crossover point. I mentioned often on the show either that, probably more charity, maybe working less, maybe not working at all, maybe doing something else. It's really hard for me to answer that at the moment. Specifically that I come closer to that decision point. But so far it's been really supportive, but for the same reason I'm not speaking about it at work. I think it's also none of someone's business. And I also work now, maybe I work in a good environment, but I just don't feel comfortable about it. I don't need any negative impact on that. I enjoy work so much. I don't want to spoil it with this kind of sentiment. And there will always be some people that are jealous. And I just don't want to lose energy on that at all. So better I just don't speak about it.
Yeah. I get that. For me, it's water off a duck's back. If someone wants to be negative to me, as I said earlier in the show, it's my money.
Yeah.
I invest it whatever way.
And so far, it has not done me any harm speaking about it. Actually, I think it built more trust even. So in my case, it worked out well. And my boss is one of the best I ever had, and very supportive. So no issue there at all.
Yeah. So I think, to answer Kevin's question, it depends on your relationship with people and what them people are. And look, you can judge characters for yourself. There's some people I would say stuff to, and some people I wouldn't.
And I would say that I'm a manager myself. Any manager that asks the employee, where do you see yourself in 5 years, and expects an answer, should not be a manager. I mean, it's one of those questions that everyone knows you don't get a reliable answer. Ask the boss, the same question, they will probably say, "I don't know."
Yeah.
So why would you expect that from your employee? It's one of those questions that has utterly no sense asking. Yeah. So I think either in this case, in Kevin's case, you should rather challenge the boss even asking this question and wonder if he has a capable boss.
Hussein has asked us about our thoughts on what is the most resourceful to get through: news about the companies, the financial reports, or analyst articles.
Financial statements first. They can't lie on that one. Well, they can do, but then it's fraud, which kind of happens less in that case than lying in the news. So for me, if I go to first the financial reports,
Yeah.
then the news, and all in the end analyst ratings. Usually I don't even look at them because I've seen too often that analyst ratings move with the price, not necessarily with the underlying performance of the company.
Yeah, I prefer to look at the credit rating agencies, what they say about the company.
Yeah, those reports are actually quite good.
Yeah, I prefer that over analyst articles.
Yes,
at least,
definitely.
at least in them, sometimes they are a little bit more biased to the bull side, but they always
Yeah.
have to tell you why they would
Exactly.
downgrade them or upgrade them. So
Exactly.
so it's worked. Jeremy Shirley has asked us the endless debate over individual companies or ETF funds. Why? So, which one do you think is best, and why, in your opinion?
If I would be in America, my portfolio may have looked like 70% Schwab dividend growth ETF. In Europe, it's a total different story, Jeremy. And Jeremy is the guy that we had on the show, right?
Yeah.
Here, and in Europe, it's different. So I don't own ETFs, only something in a pension vehicle that I have, but not because I need dividend growth. And there are a few ETFs that have this. I think it's FUSD as an example, but they typically yield about 1 to 2%, and that makes no sense in our portfolios.
Yeah, I'm going to say for an average investor, I would say ETFs and funds, regardless if you're from Europe or the US, and the reason being, most people are not investing at all. So
yes, when you're speculating through that, 100% agree.
Janssen has asked us, as European investors, do you have a maximum allocation for USD stocks to limit FX risks?
No, but on general, my portfolio hovers around 50 to 60%, and I feel very comfortable about that.
I don't have maximum either. I think it's roughly around 50-50 at the moment. So
I think if you naturally start to expand your horizon to include Canada and Europe, you will find enough companies that it naturally kind of balances it out.
Bjorn has asked us about your dividend portfolio sheet. He's using this and finds it really good, but when he sells a company, what should he do? So do you keep them in your sheet, or do you remove them?
I keep them for the simple reason that deleting them costs time.
Time is money. Carlos has asked us, you talked about letting your winners run, but imagine you have two stocks, each 28% in profit, but they are only worth 1% of your portfolio. Should he sell them then?
So, I mean, he needs to decide that on his own. But I do each year I do a portfolio cleanup. Yeah, because there are indeed companies in my portfolio that I don't need anymore, that I don't look after, and those are typically good candidates to just sell and to reinvest in the stocks that where I have more conviction. So I would look at it from that point of view.
Yeah, I think it's a tough one. Should you sell just because they're up 28% and 1% of your portfolio? No, why?
No.
You should have sold them before that if you don't want them. So, Dino has asked us. He's asked you. So in episode 213, you spoke about high yield on cost for a Microsoft position, especially compared to the low current dividend yield of the stock. However, it got him thinking: is the high yield on cost something that is really to cherish? High yield on cost confirms strong dividend growth, but the flip side is that one missed to reinvest the dividends and average into positions during strong growth in share price. I think it's basically asking what you were talking about earlier.
Yeah. So I think I want my portfolio to be diversified, have a mix of high yield, let's say normal yield, and low yield. One offers maybe a bit more dividend growth, the other one more current yield. I get a nice average yield now of 3.65%. Let's consider this an ETF where the dividend safety of my portfolio is quite strong. That's really what it is about. Now, when you think about Microsoft, it's already a full position, so I would not reinvest it anyway into the company. Yeah.
Okay. Dividend Phil has asked if we would ever sell a stock purely based on identifying a better opportunity. There's no dividend cut or change in business fundamentals, so it's purely opportunity cost that you've identified.
Only if it is of the category of the cleanup. And for you?
For me, no, I would just buy the other company. I wouldn't sell. I would just
because new cash is coming in, right, via your salary.
Yeah, exactly. Yeah. RM has asked us, I noticed that many healthcare stocks have a big difference between earnings per share and adjusted earnings per share. Why is this?
Because they keep R&D expenses out of it. They see that this is kind of double accounting. IFRS needs it as an example. So they rather leave the R&D expenses out of it in the adjusted EPS. And they also often need to write down on, because they need to write down also on a lot of the pipeline things. Yeah.
So which numbers should he use?
I would look at cash flow mostly, free cash flow in this case. If you doubt, this tells you more. Yeah. But I think what you can do is you can always go to the notes and see what the adjusted EPS are comprised of. If there are restructuring charges in there, don't count them, please, in the EPS. This is an ongoing business. All these companies are every 1-2 years, they are changing. So the restructuring costs are, for me, like daily operations, even though people may be impacted with it, with being fired and let go, but that definitely shouldn't be in the adjusted EPS, but that's what they often put in there. I would, in this case, purely look at, for instance, the R&D expense. If you agree with that one, leave that one out and see what the EPS is, the adjusted EPS, and use that as a basis. It requires a bit more homework, but if you're anyway interested in buying a company, then I think those few additional minutes could get you a much better view on the pure earnings quality of the company.
Nice. Jan has asked us about books that we have read that are not about investing, but have got you thinking or have concepts that are related to investing. So he gave 2 examples. One is Thinking in Bets, and the other is Mistakes Were Made, in brackets, not by me.
Nothing that comes to mind so quickly. No.
It's a tough question. I can't think of definitely any recent books. I can't think of anything like that.
Yeah. I mean, I read some good biographies about sportsmen and such, and also from entrepreneurs, and it's always about taking and being bold, and taking risk. But often what people associate risk with is like high losses, but sometimes it's just like nobody's doing it, so what am I missing? Or so with that, I think this part of conviction comes in. If you also, how sportsmen are, they often say like it's their mentality, their mindset. So I learn a lot from that, but I learn a lot from that generally in life.
El Kuba, what are your thoughts about the current situation in automobile business in Europe?
Stay away. I mean, for me, what's happening in with Germany, even the BMW and such, I believe, they are now trying to convince German politicians and the European Union to not put these tariffs on Chinese cars, because they're also selling a lot in China. Yeah. But in my opinion, like I'm like a broken record. I don't know what's happening in Germany there, and the car industry as well. It is like a canary in the coal mine, I think. Yeah.
JVDK, what's your take on high yield baby bonds and preferred stocks in the US?
I don't really have an opinion on that. They may fit in a portfolio. I'm just not interested in it. It is so, I think I may be smart investing a bit in that. But for me, it's always about focus and the time I want to spend on learning something. And for me, the more I start going into other areas, whether it's baby bonds and preferred stocks, or whether it's investing in Japanese stocks, it requires me to learn something again. Yeah, and this distracts me from what I'm currently focused on. So it's mostly that reason. I think the investing world is like a candy store.
Yeah.
There's so many options, and I think most people get lost because of all the options. So I have just chosen a strategy. I'm sticking with it as long as it works for me. It has been doing this now for 10 years. There's enough distraction on there. There's always, like, let's say, a girl that looks nicer. Yeah. But I just try to be happy with the beautiful woman that I have. That's how I look at investing.
Yeah. You risk becoming, what we say in Ireland, the jack of all trades, but a master of none.
Yeah, that's probably true. So maybe I'm losing money with my investment style, with my focus, but in the end, I think I'm getting to my goal at the pace that I set for myself.
The fire engineer has asked us if we have ever encountered any unexpected difficulties with having a podcast. So anything that we didn't think of before we started.
Well, I would have never imagined that we are still 4 years later talking with each other. Yeah.
I think the hardest podcast technically is when we're both in person together, because
Yes.
we don't have a setup for that. We're so used to doing it remotely
Yeah.
that our setup is not great for that. So
Sometimes it's calendar management, right? We had in the whole history, we maybe missed 5 weekends, 6 weekends, because for whatever reason, right? Both gone the whole weekend, not having chance to pre-record. So I think calendar management in the end is the hardest. But come on, after 4.5 years doing this podcast, missing 5-6 times is, I think, quite an accomplishment. Yeah, because we do this all out of passion. Yeah. So the commitment is really there.
Yeah, I think it's less. I think it's 2 that I can remember, but we won't
I
argue.
think a few more. I think a few more.
Sebastian has asked us, in the last episode, you said that you had sold BASF. Are you looking at any other companies in this sector? And he's mentioned a couple.
Yeah, not necessarily. No, I think the sector is not yet at the stage where I'm interested in it. But he did mention Eastman Chemical and Fuchs SA. And I looked into Fuchs SA just briefly, just through my screener. And Fuchs SE is it's a manufacturer of lubricants. So probably they make Durex gel and related specialty products. I don't even know what it is. Probably a satisfier or something like that. They're based in Mannheim. So German company founded in 1931. So first of all, check 3.36% dividend yield. Second one, 31 years without dividend cuts and 22 years of consecutive dividend increases and a 5% CAGR over the last 10 years. So the only issue here for me is a little bit valuation. If I would use the Chowder rule as a criteria, because 5% plus 3.36 makes 8.4, let's say, and it needs to be more than 10, rather towards 12 for me to think like, whoa. Yeah, but it's one for more research. And I know I've seen this stock more often in the past. I just never really had the attention to it. But when I saw the dividend growth chart, my heart started beating just slightly faster. And I felt like, okay, I need to check this one. So it's Fuchs, Fuchs SE, German manufacturer.
Yeah, ticker symbol FPE is the ticker. Okay, Forever Learning.
Not PFE, that's Pfizer, but the way around.
Yeah, FPE. Yeah. Forever Learning. 3 key stocks with high medium yields are dropping a lot in the last few days. Vici, Agree Realty, and British American Tobacco, which is kind of surprising to Forever Learning considering the expected rate cuts. Any thoughts, as I was hoping to add both British American Tobacco and Vici? I mean, for me, it's the same. I think I've spoke about all these 3 over the last couple of months on the podcast. I don't think the share price dropping over the last few days is anything to concern me. just because rate cuts are going to happen doesn't mean they'll go up in a straight line either. So there will be other factors that come into play. But yeah, I mean, I've no concerns over those three. Nothing has changed fundamentally on all those three companies. So if they're dipping, it's probably a buying opportunity.
Nice.
Bay Brick, what are your thoughts on the company Cranswick? Seems like a long streak of dividend hikes and with low dividend tax in origin. So it's a UK-based company. It's also a food producer. And these seem to be doing quite well in the UK over the last 18 months. I spoke about Greggs and so on the show. They've got revenue of about 2.6 billion, and they look to have a 34 years of unbroken dividend growth, which is quite impressive. You can see it's really ramped up since 2017. It's kind of accelerated. And the share price has gone like that as well. It was kind of flat for between 2019 and 2023, and now it's gone like an S-curve. And because of that, the dividend yield sits at around 1.78%. Payout ratio is 42%. So yeah, they've seen crazy growth over the last couple of years, both top line, bottom line, dividend growth as well. So it does look like it's a nice company to own, but I'm just wondering, is it too late to own them? Is it better to own them 5 years ago? Is that growth going to taper off and slow down to what we see historically? I don't know, but look, I don't know an awful lot about the company other than it's in the food service sector in the UK, which seems to be doing quite well, and the numbers look actually quite decent. So I would say worth checking out. I would say. Adam Bacon, if you had to pick one company from your portfolio right now that you would be happy to average up on, what would it be?
ASML.
Ah,
Heavily overvalued, but I could own a few additional shares. I mean, overvalued for a person like me.
Yeah. Average up on in my portfolio. I don't think there's anything too overvalued in my portfolio. I'm looking at. I'm quite heavy, as you said, in some of these stocks, but in real estate as well. If I was to go, it'd probably be Agree Realty,
Oh yes, Agree Realty, definitely.
They've jumped up quite a bit in the last couple of weeks, so they would be up there. And then the last question, and it's non-dividend related, and it goes to Rafi. Off topic, the new format of the Football Champions League. Do you watch more, less, or the same amount of games as before?
I don't watch it because it is on Canal Plus over here in Poland, and I've got Viaplay to watch Premier League and Formula One. I also have Disney Plus. I also have Netflix. So to add also Canal Plus is becoming too much for TV subscriptions.
Yeah. Rafi, what I will say is I hate the new format. I just do not like it at all.
So what is the new format then?
It's really complicated, but you've got one table.
Yeah.
So you don't have a group anymore. So you've got one table, 36 teams, 38 teams, something around that. Top 24 teams will go through. I think the top 8 teams will go directly through to the knockout stages, and then between 9 and 24 they go into some qualifying.
And how do they play? How do they play again? All or just
no
at random?
At random, you're playing random teams. So like it's bizarre. It's bizarre. Liverpool have played Bologna. We're playing AC Milan, Bayern Leverkusen, Real Madrid.
I would love them to go back to the good old knockout days from the first round. Why do we need to protect the rich clubs? Because now there is statistically such a small chance for, like, let's say the Leicester of the Premier League to win the title.
Yeah, I honestly think that the Champions League should be just the champions of each country. That is
a knockout.
And knockout. Straight knockout, nothing else. Just the champions. Liverpool will never get there. We only won the league once, but it doesn't matter to me. Champions League should be for champions only, and play it
and knockout,
and straight knockout.
And that means that Real Madrid may lose in the first round.
Exactly,
and that's the beauty of it. I think it's better for the football fan.
Exactly, and higher quality games because you have to win every game.
Exactly.
Cool. Yeah, non-dividend related. So thanks for that. That's the last question.
That's it. Thank you so much, Derek. And next week, many mystery if all goes well. I'm really looking forward to it.
Yeah, we're long overdue a guest and looking forward to having Manny Mystery on the show. So until then, thanks to all our listeners again, and we'll see you all next week.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.